Chapter 1. The basics of investing in stocks. Delayed gratification is a strong suit that few have, and this is why investing has always been a challenge for many. You want to make money, but not in a decade or a couple of years, but right now. Ponzi schemes aside, profitable investments that can actually build you wealth for a lifetime take time and lots of patience. These two things are probably the most important tools that any beginner in stock market investing needs to be aware of. Our motivations for investing may differ, but ultimately all investments have one goal in common: to make a return or profit on the investment. You may be eyeing early retirement, you may be in it for financial freedom, or maybe you're just sick of having your money sitting in a savings account attracting point-nothing interest. Regardless of what your goals are, the idea behind investing is that you use your money to make more money. The stock market presents a unique opportunity for both retail and corporate investors because anyone can do it at any scale. You can invest as little as $1,000 or as much as $1 million. There are room and opportunity for everyone to get in and make a decent return on their investment. That said, the stock market is not the way to go if you want quick money. Stocks, like most other investments, have one thing in common: they depend on the power of time. Time is your biggest ally when it comes to investing. If you have been waiting for a magical moment when you will have enough money to start investing, the bad news is that you will probably never have enough money, and the other bad news is that the right time to start investing was yesterday. A common misconception that most people have is that you need to have a lot of money to start investing. In actual fact, people who invest do not necessarily have more money than you. They simply make investing a priority. And because they make investing a priority, they end up having more money than you. See how that works. Unlike consumption, investment takes money out of your pocket and puts it towards your future. When you can think of investment as an insurance policy to safeguard your financial future, then the decision on when and if to invest becomes pretty much a no-brainer. Nobody wants to be cash-strapped forever or have to work themselves to the grave because they did not put their money to work when they had the chance. The beauty of this golden age of technology that we live in is that anyone with the will and determination to do so can access all the tools they need to start investing in the stock market. This ease of accessibility coupled with its affordability has made the stock market increasingly popular with retail investors. With just a few $100, you can find an online brokerage at the click of a button and get started as an investor in the stock market. Yes, it is that easy. Before you jump on the bandwagon, however, it is important to understand what you are investing in. The natural starting point is, of course, understanding how the stock market works. How does the stock market work? It is no coincidence that most people who have wealth have a big part of this wealth invested in stocks. Stocks carry their fair share of risks for any investor, but when done right, stock market investing can be one of the most efficient ways to build and retain wealth. A stock market is an exchange where people trade by buying and selling shares on traded companies. Once you have bought shares in a company, your stock gives you ownership of a small part of that company. With this ownership, the value of your investment will be determined by the movements of the price of the company's shares. If, for instance, you bought Apple stocks and the price moves up while you are holding the stock, then the value of your investment increases. On the other hand, if the price of the Apple stocks decreases while you are holding the stocks, the value of your investment decreases. The price of a stock is driven by the forces of supply and demand. Naturally, when the demand for a particular stock is higher than the supply, the price of that stock will increase. In much the same way, when the supply is higher than the demand, then the price of that stock will decrease. In essence, the stock price is a reflection of the value as set by the market conditions. When you buy a stock as an investor, your general goal is to make money when the price of the stock increases. This is why a big part of investing in the stock market is knowing how to select the right stocks to buy. When the price of the shares you have appreciates, you can sell your shares at a profit. This means that you will get a return on your investment and you can reinvest your capital back into the market, or you can cash out. The beauty of stock market investing is that there is usually no limit to how long you can hold your investment. You can keep your shares for 20 years, or you can choose to sell them when the share price appreciates. This will ultimately depend on what your end goal is. Price appreciation is not the only way to make money in the stock market. Dividends are payments made out to shareholders when a company makes a profit. This means that depending on the type of shares you have, you will receive dividends from the company whose shares you hold. For instance, if you bought Tesla stocks and the company pays out dividends quarterly to their shareholders, you will get a percentage of these dividends based on the value of your shares. You can choose to take these dividends as a cash payment, or you can choose to reinvest them back into the company by buying more shares. It is important to note that not all companies pay dividends. This means that if you want to make money in the stock market by earning regular dividends, you will need to understand the type of stocks to buy and which companies' stocks will get you dividends. Stock exchanges like the NYSE New York Stock Exchange, NASDAQ, the Tokyo Stock Exchange are some of the largest exchanges. However, stocks are also sold in over-the-counter markets where they trade directly through brokers and not in open exchanges like the NYSE. These markets are referred to as secondary markets, where investors trade stocks by buying and selling amongst themselves. Basic terms and concepts: stocks. A stock is a share of ownership in a company. Stocks are also referred to as shares. When you buy a stock, you acquire a fraction of ownership of the company whose shares you have bought. When you buy stocks, you become a shareholder in a particular company, and the percentage or size of your shares will determine the dividends you can earn. Investors in the stock market can make money from their stocks in different ways. You can earn money in the form of dividends paid out on the shares you own. You can also earn money by selling your shares or stocks. Common stock. Common stocks give you ownership of a company based on the number of shares you own. Common stocks are the most basic type of shares to own, and they entitle you to dividends where applicable and voting rates proportionate to the shares you own. Preferred stock. Preferred stocks entitle you to a fixed dividend rate for your shares. With this type of stock, you earn dividends before shareholders who have common stock, but you do not get voting rights. Unlike shareholders of common stocks, preferred stocks give you a guarantee that you will receive dividends on your stock. Penny stocks. A penny stock is a stock that trades for less than $5 per share. Penny stocks are typically short-term holdings where you want to take advantage of price movements in volatile markets. Penny stocks investing works for short-term investors who do not plan to hold the stocks for long periods. Blue chip stocks. Blue chip stocks are shares of large established corporations that have solid reputations in the market. Blue chip stocks are characterized by solid balance sheets and steady cash flows. Most blue chip stocks have a history of earning increasing dividends for their shareholders. These types of stocks are ideal for long-term investors who want to hold stocks for long periods. Primary market. In a primary market, companies sell their shares directly to investors. In most cases, companies in primary markets sell to corporations and institutions rather than to individual investors. Hedge funds, mutual funds, and similar investors are typically the kind of investors that buy shares directly from companies in primary markets. Secondary markets. In a secondary market, investors buy and sell shares amongst themselves. Individual investors buy shares in secondary markets. In this type of market, you can choose to buy shares of a particular company or a mix of different companies' shares in exchange-traded funds or EFTs. Over-the-counter markets. OTC markets are where companies that are not listed in exchanges like NYSE trade their shares. In OTC markets, there is no public price for the shares, and the value of the transaction is dependent on the buyer and seller. Bid. A bid is a price at which you want to buy the share. Ask. The ask is the price at which the seller wants to sell the share at. Spread. The spread is the difference between the bids and sell prices of a stock. If you want to buy a stock at $50 and the buyer wants to sell it at $45, the spread in this case is $5. Volatility. Volatility refers to the movement of share prices in the market. When the price fluctuates widely within short periods of time, then it is said to be highly volatile. The higher the volatility of a particular share, the higher the risk associated with it, and also the higher the profit potential. Dividend. A dividend is the percentage of a company's earnings that is paid out to shareholders. Dividends can be paid out annually or quarterly depending on the company. Not all companies pay dividends to the shareholders. Broker. A broker is a trader who buys and sells shares for an investor for a fee or commission. Bear market. A bear market refers to a downward trend in the market where stock prices are falling. Bull market. A bull market refers to an upward trend in the market where stock prices are rising. Beta. Beta is the measurement of the price of a stock relative to the movement of the whole market. If a stock moves 1.5 points for every 1 point move in the market, then it has a beta of 1.5. Index. An index is a measure that is used as a benchmark to gauge market performance. Some of the most famous indices include the Dow Jones and the S&P 500.